But I also learned that there is rules to this game. And I'm a person that likes to know the rules. I believe that I played football for many, many years. I coached football for many, many years. And if you tell me the rules of the game, I could then master it. And the only way to learn the rules of the game was me to transition over to become a mortgage loan officer. Because the banks ain't gonna tell you straight up every rule that's out there. And nobody else will, because most people who don't have that license, more people walk around without that license than have that license. So therefore, you're gonna get a lot of bad information. There's tons of bad information out there. But then on top of that, you're gonna get a lot of slickster information. I call it the slickster stuff, whereas it's simple, you can just do this, or simple, you can just do that. And it don't make sense what they're talking about. So that's my transition into the game was, hey, you know what? Let me learn the rules. And then I'll teach others the rules so we can all play together.
Absolutely. All right, welcome Bootstrappers to another episode of Bootstrap Millionaire. And I'm really excited about this conversation I'm having with a long-term friend, business partner, and colleague of mine. His name is Mr. DeMarcus Ross, better known as D. Ross, the mortgage boss. Welcome to Bootstrap Millionaire.
Hey man, thank you for having me, bro. You know, it's been a while. I've watched a lot of your interviews you've been doing and everything, and some of the folks, a lot of them I know and everything like that. And it's just an honor to be here, to be invited to the platform. You're doing great things, my brother. I'm very proud of you.
All right. Well, I'm excited because I know we're going to get into a very good discussion about mortgages, real estate, and my hope is that a lot of our listeners can take some great information from it. My hope is that this is kind of like a masterclass for them, right? A masterclass on mortgaging and financing. But before we get started, I want you to kind of let my bootstrappers know who you are personally.
Oh, okay. That's easy. You know, I'm DeMarcus Ross, aka D. Ross, the mortgage boss. You can find me on Instagram at D. Ross, the mortgage boss. Started this journey in the real estate and mortgage game back in 1997. Actually was an IT consultant at the time and purchased my very first property. And I purchased it I guess I was bored, and I purchased it. And not really knowing what I was getting myself into, went through and got all the paperwork together and went through all the hoops and everything it takes to get a mortgage. And again, I bought a property with an easement on it and never knew it till a mentor of mine said, hey man, you know that property has an easement on it, because he looked at my documents and everything. And, you know, but in buying that property, I got an opportunity to just really sit down and start understanding what it took to buy this property, and the true meaning of being a homeowner. And then as I began to grow in the IT space, I needed somewhere to park my money, so I started dabbing in other fix and flips or things like that, just so I could, you know, move some money around and try to increase my wealth, so to speak. But I also learned that there is rules to this game. And I'm a person that likes to know the rules. I believe that I played football for many, many years. I coached football for many, many years. And if you tell me the rules of the game, I could then master it. And the only way to learn the rules of the game was me to transition over to become a mortgage loan officer. Because the banks ain't gonna tell you straight up every rule that's out there. And nobody else will, because most people who don't have that license, more people walk around without that license than have that license. So therefore, you're gonna get a lot of bad information. There's tons of bad information out there. But then on top of that, you're gonna get a lot of slickster information. I call it the slickster stuff, whereas it's simple, you can just do this, or simple, you can just do that. And it don't make sense what they're talking about. So my transition into the game was, hey, you know what? Let me learn the rules. And then I'll teach others the rules so we can all play together.
Absolutely. Well, let's first start by defining what a mortgage loan officer is. And I know to some people this may sound elementary, but I think it's important to do that because, as we know, mortgage loan officers, there are not many of them in the U.S., right? Especially when you compare them to real estate agents. So sometimes people, I think, confuse mortgage loan officers to real estate agents, but there's a difference, right? So in layman's term, how do you define what a mortgage loan officer is?
Great question. A mortgage loan officer, licensed mortgage loan officer, and I'm going to differentiate between the two. You can call up Wells Fargo, Bank of America, Chase, whoever, and they'll have a person sitting at a desk who's their mortgage person. They don't have to be licensed because they can use the bank's licensing and still sell you a loan. Okay, I'm not with a bank. I'm an independent mortgage loan officer. I have a license. I'm licensed in Georgia and I'm licensed in Florida. I can get licensed in any state I choose to. I just chose Georgia and Florida because of some business reasons why I chose that. But there's 188,000 licensed loan officers. I'm not counting the ones in the bank and nothing like that.
Understood.
188,000. 8% of that are African American.
Wow. Only 8%.
Only 8%. It's not easy to become a licensed loan officer.
Wow.
It's very rigorous testing you go through. The class work is 20 hours, called a safe class. You take it for 20 hours. But that's probably the easiest part of taking that class.
Yeah.
Because that test is a monster.
Right. So there's, how many real estate agents are there in the country?
Whoa. Over 1 million, I want to say.
Yeah, I think the last count was maybe 2 to 3 million.
Something down there. It's a lot of real estate agents, and nothing against the real estate agents. It's just the simple fact that this mortgage loan origination loan officers, licensed loan officers, they don't sound sexy to people.
Well, because it's finance.
Because it's finance.
Finance isn't sexy to most people. Yeah.
Most people don't like to deal with the numbers and understanding what money's really all about. Most people would prefer, I'm gonna show you a house.
Correct.
I'm gonna get dressed up. The wallpaper looks good.
Yeah.
You know, the cabinets look real good. That's what they prefer. I'm not against them. I just think that, in my opinion, I talk about money, I leave property alone.
Correct.
They talk about property, they leave money alone.
Yeah.
Because we can get jammed up crossing each other's street.
Correct. Yeah. So with millions of real estate agents and only a few 100,000, about you said 180,000.
Yes, that's right.
Mortgage loan officers, and again, only 8% of them are African American. It makes me now understand why there's so much disparity in real estate ownership amongst the Black community.
Okay.
There's not a lot of representation, particularly when it comes from a finance perspective. There's not a lot of representation within the Black community when only 8% of the licensed loan officers are African American.
I had a conversation with a real estate agent last week, and the brother touched on something that I did not know. Even as a licensed loan officer, I did not know this. He said most most African American people who are purchasing homes are women. Black men are not purchasing homes at the rate that Black women are. And I was stunned. And he said he found that most Black men are not in finance. He said, I was the first finance brother to walk through the door to introduce himself as a licensed loan officer. And now that I think about it, I know a handful of brothers who are licensed loan officers. Not a lot, just a handful out here in Atlanta. And I'm in Atlanta, Georgia, and I know a handful. It's not a lot of brothers out here in this space.
Yeah. Yeah, I think that's something that definitely needs to be, it should be a concern within the African American community, because there will always be a disparity amongst our community when we don't have proper representation. Because the truth of the matter is that, I mean, I don't know if I'm being educated correctly, unfortunately, by someone that doesn't look like me,
right,
when it comes to finance, right? Because as we'll talk about a little bit later on, there's a lot of ways lenders, brokers manipulate the numbers and things of that nature when it comes to people getting financed on these properties. Maybe they don't get offered the best program and the best deals because it doesn't make the type of money that the broker or the loan officer is looking for. So I think there certainly needs to be some representation.
Yes, there definitely does need to be that. And on top of that too, the number one thing I always say is, and I say this to all my borrowers that come to me, we gotta be fully transparent. Transparency is the key.
Yeah.
I often tell them, I say, and I gotta say, and I say, and it's I actually stole the phrase from somebody else, but I tell them I'm your lawyer for money.
Right.
You know you killed the person. You know you buried the body. Tell me all that. Because at the end of the day, they're going to find it.
Yeah,
and
absolutely.
when they find it, I got to be able to argue a case for you to get to the money.
Absolutely.
So, that's what I tell them. And I break the ice with that because at the end of the day, I've had situations where people didn't tell me something.
Yeah.
And they found it and they said to me, I'll never forget it. How they find that? Think about it. You're going to borrow $500,000 from somebody and they don't know who you are?
Oh, yeah.
I don't know where they loan money like that at.
Absolutely, absolutely. So let me ask you, why is this area of business important to you? Now, you started out in tech as a technical consultant, got over into finance. Why is this area of business, real estate and finance, important to you?
I didn't get in this game for money. I'm actually in tech for money, make a ton of money in tech. I got in this game to help my people because of the disparity. It's bad when you hear the things that are misspoken about in our community as far as finance and things like that. And it's bad when you hear it and then you're raised on it. And then you get out here and you find out that, oh no, that ain't true. So I really got in the game to just really say, hey, listen, let me help my people become more educated on how to purchase a first home or how to be an investor and things of that sort, because there's a lot of disparity out here as far as between our culture and our race and all the others.
Yeah, yeah. And I encourage if any bootstrappers that are listening to this podcast, my hope is that they are encouraged by your story and many of them will start looking at how they can become mortgage loan officers or get into the finance game, because again, there is a need for people of color in this industry. Yeah. With that being said, how does someone become a loan officer? What process did you go through to become a loan officer?
Well, this process is the process. I never forget it. I came to a very good friend of mine some years ago, and I asked him a question. I said, "Hey, man, I know you do commercial loans. Why don't you do a residential mortgage company?" And my good friend told me, "Nah, I ain't making no money. I ain't got time for that right there." And I said, "Okay, cool, no problem." I walked away. A year later, this good friend of mine came back to me and said, "Hey, man, I got a residential mortgage company. I need you to become a licensed loan officer." And the first thing I said to him was, "I had time a year ago." I don't know if you know who that guy is. By any chance.
I don't know. Who is that guy?
Bootstrapped Millionaire, Mr. Tim T. Mercer. And for those bootstrappers who out there, that's actually a true story how it happened. Because I had the desire to become one, but I never knew how.
Yeah.
And then Tim actually said, "You need to call this lady named Cousin Carol."
Yeah.
And I'm going to give her props.
Yeah.
The sister's a bad one.
Yeah, she is.
So I walked into this class online. We took it on a Zoom call. And it's 20 hours. I am a bold person. I did mine 2 10-hour days straight in front of a computer with the camera on. And I was like blown away of all the information that comes at you in 2 10-hour classes. And the way she was just delivering the information was like it was a part of her body.
Yes.
She was just throwing it out there. And then she also talked about the exam. And the exam itself was very, very challenging to get prepared for, because when she told you the rules of the exam, the rules are there's 125 questions. They take 5 random questions and throw them out. But you got to score 75 on the exam. So me, I'm smart. I'm an IT guy. I said, you know what? I can look at what she gave me and I can steal points from every single section to pass this exam. And lo and behold, the sections that she gave us and stuff in were pretty intense. The laws are really, really, really like studying for a bar.
Yeah, they are.
Then you got ethics and you have ethics, and you have LO activities and things like that. So you take this exam, and if you pass it, you go into round 2 of it all, which is you give up them fingerprints, and you let the FBI crawl through your background, and they crawl through your finances, credit, and everything like that, and you wait for your approval to become a licensed loan officer. And then every year you have to do an 8-hour class to stay up on keep CE, they call CE class, continuous education class. You got to do 8 hours every year. So every year, about August for me, I'll go sit in one of Cousin Carol classes and learn whatever it is that they're teaching that time for 8 hours. But it is not an easy process to go through to get.
Yeah. I know a lot of people who have failed that class over and over again.
Yes, if you failed the first time, it's a 30-day wait.
Yeah.
You failed the second time, I think it's a 60-day wait to take it again. You fail the third time, it's a 6-month wait. So it is a way for the system to keep the numbers low.
Yes.
Yeah.
Yeah. Because prior to Dodd-Frank, I remember before the '08 crash,
Wild, wild west.
it was the Wild Wild West. You didn't have to have a license to be a mortgage loan officer. And of course, when the '08 crash happened, they blamed the '08 crash on the mortgage industry, which as a result, the Dodd-Frank ruling came about, which now requires all people, loan officers, to be licensed. And
that is absolutely correct.
Yes.
Yes.
Yeah. So let's talk a little bit about the landscape of finance. You talked about Cousin Carol having a lot of information, and she shared a lot of information with you. You've gone through this rigorous class and took this this exam. Let's talk about the different types of loans, because I don't think a lot of people know that there's different types of loans. There's a difference between what we call QM loans and non-QM loans. Explain that to us.
All right. Let's start with the easy ones. QM, which is qualified mortgage, is basically your Fannie, Freddie, FHA, VA, USDA. That's basically it. And
who are Fannie, Freddie, these acronyms that you put out?
Fannie Mae is a government entity, as well as Freddie Mae is a part of the government. Freddie Mac, excuse me.
Freddie Mac, yeah.
Freddie Mac, yes. And then you got the Fair Housing Authority, which is FHA.
Yeah.
USDA is USDA. And then you got VA, which is for the veterans. And these particular entities of the government actually help people with programs to qualify for certain loans. Now, you have lending limits for each one of these programs. Fannie and Freddie is what they generally say is their conventional side of the house, and then you got the FHA side of the house. Those are two most common ones people use today. Of course, you got VA, whereas the veterans in the military use your product a lot. USDA is generally used out in rural areas where they're way away from major cities and got a ton of land, farmland, things like that. I personally have not written a USDA loan because I live in Atlanta, and I haven't had a need to write one. I'm not saying I wouldn't write one, but I haven't had a need to write one. But generally for me, myself, I do more FHA, and in the government space, let's say in the QM space, I do more FHA, more and the conventional Fannie Freddie loans.
So QM is more government-based loans.
Yes.
Non-QM is when you get outside of the government
space,
security and guarantees and things of that nature.
Yeah, insured and guaranteed. Yeah. You get outside of that. The non-QM space pretty much handles your I call them the special loans. Loans for specialty folks, such as your QM space really has the small business owner in there who does not want to go for a QM loan, who wants to do alternative financing. Because just because you work for somebody doesn't mean that you gotta always do government financing or do one of those programs. You can oftentimes find a way to qualify for a non-QM program, and that non-QM program doesn't always have the same stipulations or pitfalls, I would call it, that you have in the QM space. Because the QM space is rigid. It's real rigid to what you can and cannot do. And even down to like disclosures and things of that sort. Everything is in timing in that space. Whereas in that non-QM space, we could be talking about a hard money loan in non-QM space. We could be talking about a bank statement loan or even a DSCR loan. That's all non-QM. So those loans there have totally different guidelines.
They're a lot more flexible.
Yeah, a lot more flexible. They are. And for me myself personally, I love that space over there. I love it because now I'm getting the opportunity to say, hey, Mr. Barber, I know you got a shop, and I know you got 10 shares in this shop, and I know you want to become a homeowner or even an investor. You ever thought about buying the shop that you're in?
Correct.
Instead of going to the government route to buy the shop that you're in, let's go over here to non-QM space because you got money in the bank. You deposit money in the bank every time. Your credit is good. So let's see about, you got some money for down payment. Let's see about buying this space that you're actually in through one of these non-QM programs and putting a business name. And then you begin to build your business credit and take advantage of the tax advantages for it being in your business. And that's what I like about this program.
Yeah, non-QM, which I love as well too. I mean, it's like I said, it's a lot more flexible than the QM space, qualified mortgage space, the government-backed mortgage space, but a lot of people just don't know about it. Most people think that if they're gonna go get a loan to buy a home or buy investment properties, many times they ask for QM type loans, but the non-QM loans give you a lot more flexibility. Maybe a little bit more money down, right? Because obviously, right?
Well, here's the thing. The money down, the whole money down debacle, I call it, the myth about that whole money down. Think about this for a second. If you had $20 in your left pocket and you took it out and put it in your right pocket, do you still have $20? Okay. If you took $20,000 from Bank A and you put it in Bank B, you still got $20,000?
Yes, I do.
So let's look at your home that you're purchasing. Your home that you're purchasing to live in as your personal residence is a big savings account.
Absolutely.
So you're taking, and here in Atlanta, it gets on average 8.5% appreciation every year. So if you took $20,000 out of, let's just say, Bank A, that's giving you 0.001% interest, and you moved it into the home.
Correct.
On the CD, the closing disclosure, it's going to show a down payment of $20,000. That went straight into the home that you get to drive by, drive up in, sleep in. The $20,000 is in the walls of the house. Absolutely. It ain't going nowhere.
Yeah.
So you still got the $20,000.
Yeah.
So what's wrong with the down payment? I'm lost.
I totally agree with you.
Because that's giving me 8.5, and this was giving me 0.001. I ain't made no money over there. Matter of fact, the banker made more money on my money than what I made.
Absolutely, yeah. I just don't think the people are educated enough to understand how the game works. I think that's where it is. If people were more educated in knowing that when you're buying real estate, only thing you're doing is just moving money into that asset. The money doesn't go anywhere. You're just transferring it from one asset class to another. But what I've come to learn is that's hard for people to get their head around. I don't understand why, but it is.
Okay, I got a scenario for you on that one though. We are quick to rent apartments. Okay, and there's nothing wrong with renting. Nothing wrong with
I like renting. Yeah.
But understand the game. I'm gonna show you this game. If the apartment complex say I need a deposit, a $1,000 deposit, and you may get it back when you leave the apartment. If it's clean and up to our standards, you'll get the money back.
Yeah.
Okay. You put the $1,000 in that apartment. How much interest is it making you?
None.
Okay. You tear the apartment up, do you get it back?
No, you don't.
You lose it. So what's wrong with investing in yourself and taking 12, 15,000 and putting it into the property that you can sleep in, and then times get hard or get tight, you can go get a little bit of money out.
Yeah, that's true. Absolutely.
So in our community, we got to learn how to re-educate ourselves. It's not that renting is bad. Now, I never say renting is bad because there's right ways of rent and wrong ways of rent.
Yes.
Which I'm not going to get into that on this podcast. But
no, we can dive deep into that later. Yeah.
We say that for later.
Yeah.
But to your point, though, Tim, it's just an educational mindset that we got to overcome.
Absolutely. So let's talk about interest rates, because I think that's a big thing that a lot of people are concerned with. Obviously now interest rates are a lot higher than it was back in 2018, 2019. But how important are interest rates to you as a mortgage professional?
Interest rates to me is just the cost of doing business. That's the way I look at it. The interest rates are really controlled technically by the borrower. A lot of people don't know that. Yes, the Federal Reserve sells the money at X price. The banks have an overlay so they can make money at Y price.
Okay.
Then your credit score determines the final price of how much you're paying for the money.
Okay, step back, and I want people to make sure people understood what you just explained.
Okay.
You said the bank borrows, so you're saying the bank is borrowing money from someone else to lend it to me as the homeowner.
That's correct. The bank does not have, the only money the banks have is the depositor's money.
Absolutely.
So if you go out and you put $1,000, I tell you what, you put $10,000 in the bank, come back 2 days later and say, I need my $10,000 back, you may have to sit and wait for it.
You will, yeah.
You ain't getting it back. Because they don't gave that money to Jimmy on the corner down here. Jimmy bought a car. So they gave him that money. Bam, he got his car. He's good.
Right.
So the myth is that the bank has money. The bank don't have no money.
Right.
The myth is that the federal government got money. The federal government got no money.
No.
The Federal Reserve, they allow us to print money so we can spend money. But the money comes at a cost.
Yes.
Like back in 2019, you mentioned the rates were low. Well, what did the Federal Reserve do when COVID hit? They gave us a 0% interest rate loan on the money. They gave the Feds a 0% interest rate loan on the money.
Yeah, yeah.
So at 0%, the bank's overlays made it 2 and 3%.
Yeah.
According to your credit score, you can get a 3% loan, 4% loan, 2% loan. You know, because the overlays were
You're saying because the bank it didn't cost the bank much.
No.
Much of that money that the bank was making then was all profit because they didn't have much of a cost for the capital.
No cost per capital because they got the money real cheap.
Yeah.
So fast forward, and I say this to borrowers a lot. If you got a 0% interest rate credit card in your pocket, you know there's a period where it expires, right?
Correct. Yes.
It's the same thing that
thing.
happened with the Feds.
Yeah.
They gave them a 0% interest rate loan,
Yeah.
and they called it due,
Yeah.
and the rates went up. And they said, we got to slow down the economy. The rates kept going up. They're trying to slow the economy down, but they're also trying to pay back this money they owe the Feds. Federal Reserve, they got to pay the money back. So that's why the floor rate might be 6%. And then the overlays may take you to 5, may take you to 7 or 8. You know, now that the floor might be...
And the overlay is the bank's margin or profit that they're putting on top of the money that they're borrowing from the Federal Reserve.
That's right.
Yeah.
That's how they make their money. And then you have to make more money because if your credit is bad and you come in there, there's another overlay that comes on top that gives you the higher interest rate. They're not saying they won't do your loan, but your cost of doing business is this number now.
Because of the fact that you're more riskier based on your credit risk.
Based on your credit score.
Yeah.
That's correct. So you have a lot of control of the interest rate, more than what you think you have.
Wow. That's interesting, yeah. And of course, we could dive a lot deeper into that. I mean, this is a very deep subject that a lot of people probably just don't understand because we assume, again, that the bank has money. We don't understand that the bank is nothing more than a broker.
That's right.
They're borrowing money and then flipping it. They just flipping the money like you flip a bird, right? They've not the bird that fly in the sky, but I mean, it's the same play. And so that's what these banks are doing, and that's how they enrich themselves by doing so. So really, when the interest rates was low back in 2018, 19, we don't realize that we were the ones that's going to carry the burden of those interest rates being so low. Everybody was excited that the interest rates was low, not realizing that, you may have been excited that you was getting a low interest rate, but you're the one that's going to reap the consequences of those interest rates being low, which is what is happening today.
Correct. Interest rates had to move up
Yeah.
Because we got to pay this money back.
Absolutely.
Even though we're still trillions of dollars in debt.
Yeah.
We can't seem to get out the trillion number.
Yeah. So I think we will eventually get out of the debt that we have, but it's going to take us going to war.
That's correct.
Right. I mean, we're $33 trillion in debt. Every American is responsible for that debt.
That's correct.
So that's the only way that the government gets out of this amount of debt is by going to war, which is going to be unfortunate for a lot of Americans, especially ordinary, everyday Americans, because unfortunately it's their sons and daughters that eventually end up going to war.
That is correct.
Right?
That's the sad part about it.
Yeah.
Is that we got ourselves in so much debt to the point where we got to crank up the war machine to try to kill the debt.
Yeah. So as we close on this segment, because we're going to take a quick break, and we're going to come back and have a more in-depth discussion around real estate, the real estate market, some of the myths around home ownership and things of that nature. So let's just take a quick break here, and we'll come back. And so from all my bootstrappers, don't go anywhere. Look for the next video so that we can hear more from our good friend, Mr. DeMarcus Ross, D. Ross, the mortgage boss.